Welcome to the daily update, where I'll go over the action in the market for Tuesday, December 5th, and then we'll see how things look for Wednesday, December 6th. We had another little down day. We're working off some of this extreme positive condition that we've been dealing with for over a week now. But at the same time, we have to wonder, is this going to develop into something weaker? Are we going to actually see more of a pullback than what we've been seeing? So far, that's not the case, but we still want to respect that and be aware of that. The market is really anticipating the employment situation report coming out on Friday. We saw the first below average day in a little over a week, and volume may stay light until Friday, but we do have other economic reports that are coming out that the market may want to react to. So let's go back and talk about what happened. Right at the open, we had a gap lower open with prices dropping below S1. We set S1 as the support level, but we fell just a little bit below that at 45.54. Then we rebounded up to the daily pivot at 45.63. We got up to the unchanged level and actually went positive and were able to climb up to R1 at 45.79. Then after that, we pretty much chopped between the unchanged level and the daily pivot, and then we closed slightly negative. We were down 0.06% on below average volume. We're still positive in the short and intermediate term, looking a little extreme, but working some of that off. We want to be careful. Are we going to switch over and go actually more negative? It's about inflation, interest rates, growth concerns, geopolitical events. That's what's concerning the markets right now. Some comments that we can make. Mega caps actually did better for the first time in a few days than the broader market. So there was a little bit of profit taking there. Moody's ended up downgrading China's credit outlook to negative, where it had been stable. If you remember a month or so ago, Moody's also downgraded the U.S. credit outlook. And so as they're seeing things developing in the world, they're not really liking what they see. They haven't changed the actual grade yet. They're just kind of putting a warning sign out there. Small and mid caps, after having 2 or 3 really good up days, now they're starting to pull back. Oil ended up closing down at 72.33. And our list on a short-term basis is getting a bit shorter. We still have our short-term ADX, which is above 40. The stochastics chart is showing working off some of those extreme conditions, but we still have some indicators that are extreme. The PMO oscillator and the slope oscillator, they're both starting to roll over, but they're still looking extreme positive. We have one extreme negative reading with the Stoch RSI. That happened yesterday, and it followed through after today's session. Intermediate term, our list is also getting a bit shorter now with the S&P 500 McClellan oscillator, the PMO studies, the NASDAQ 100 bullish percent index, and the new highs and new lows for the S&P 500 based on 10 periods. We're still dealing with this scenario that the Fed is keeping rates higher for longer. That's what we're going through right now. The big debate is, are they done if we see weaker economic reports? Or if we see stronger economic reports, are they going to keep rates the same or get to the point where they actually increase rates? We're also watching what's going on in Israel, keeping an eye on oil, and then keeping an eye on earnings. The dollar was down and interest rates were also down. That helped give some support to stocks. The 10 to the 2 and the 10 to the 3-month yield curves are still inverted. Sentiment ticked down just a little bit. It had been at 68. It came down to 67. And we are positive with our trend, and we are in a trending environment. Our bias continues to be negative because we've had 2 slightly down days. Well, Monday's session was more negative, but we had another down day on Tuesday, where our momentum still continues to be positive. The economic reports that did come out, we had the S&P Global U.S. Services PMI, the final reading. The encouraging thing about this, and I don't have a chart, is that we're slightly above 50. It came in a bit better than the last reading that we had at 50.6. This time it came in at 50.8. When it's above 50, that shows slight expansion in the economy. The big one was the ISM non-manufacturing PMI. It came in at 52.7. They had expected 52.4. So a little bit stronger than expected and up from the 51.8% that we saw last time. The JOLTS job openings, this is starting to decline. It came in at 8.773 million, which is still an awful lot of jobs, but it decreased from the 9.350 million that we saw last time. So, and here are some charts. Here's the ISM, where when we look at the blue line, which is the total, it's declining, but it's still above 50. So it's showing some slight expansion in the economy. When we look at the gold line, we're pretty much flat, and that's what the market liked. We're not really seeing an awful lot of inflation in this regard. We look at the job openings where they really dropped off. We had been going down more over the last 3 months, and this is the market right now is taking it as positive, because this was why the Fed was raising interest rates, because the employment situation was pretty strong. If we see this decline and then we see that confirmed on Thursday with the jobless claims and then on Friday with the employment situation, the market may really like that if we're seeing things under control. Then we're keeping an eye on the economic surprise index. This is from Yardeni's website, where the red line here is the S&P 500 minus its 200-day moving average. So this gives us a detrended type of reading on the market. That's the red line where it's been going up. Then we look at the economic surprise index, which has been coming down. And that is because most of the economic reports that are coming out have been weaker than expected. And that's what's giving some support to the market right now, helping it to go higher. We did decline with the 10-year yield. We're at 4.18%. We're inching ever closer back down to that 4.02% level. If we can get to that level and drop below it, the market may turn more positive. Here's our intraday chart where we gap lower, and it's really choppy. We're just seeing some really wide candles, a lot of buying, a lot of selling within short periods of time. But most of the action was right after the open, where we gapped down to S1, dropped a little bit below that. Then we came back above the daily pivot, got above the unchanged level, almost made it up to R1 before then we had a sell program come in that really took us back down below the daily pivot. And then we just chopped sideways between the daily pivot and unchanged level for the rest of the day, closing down just slightly negative. Here's our intraday chart where we were more negative before the market opened. We saw some strength come in after the open, and then the choppiness that went on for the rest of the day. And right now, right before I started to record, the futures are up about 0.3%. We don't know if that's going to hold. It's still many hours before the market actually opens, but the initial overnight session has been positive. We're still seeing where value is outperforming growth when we look at our intraday chart. The red line is above the blue line. That's a bit of a concern. But we did see some improvement when we look at the S&P growth to value ratio intraday, where it shot up right at the open and then maintained most of those gains. That is potentially positive for the S&P, and the first time in a number of days where we've seen an improvement on this chart. The end of day values, growth was up on the day, where value ended up being down for the large caps. They were down with the mid caps, but less, and they were also down, but less for the small caps. And there was an awful lot of profit taking with the small and mid caps. But this is a little bit of a concern here. We were going higher with the S&P 500, but we're seeing the growth to value ratio on an end of day basis continue to decline, even though it ticked up a little bit on Tuesday. We're keeping an eye on discretionary versus staples, where we look at the ratio, where we did see a little bit of a poke up going after Monday's session. This is turning down just slightly, but in the longer term, discretionary is still outperforming staples. Looking at our trend, where we're not extreme with the intermediate term, and we're still in a trending environment with the ADX above its moving average. The green line has been declining after I got close to that 40 level. So right now, this is just looking healthy. It's not necessarily changing, but one solid down day could switch that over to a more negative stance, but we still default to the positive here. When we look at our short-term ADX, we're still above 40, and we've not started to roll over at least yet, as the green line continues to go down, but it's still on top. So that's still a positive trend, but in the short term, our trend is looking rather extreme. Volume did come down just a little bit. We have been above average for the last number of days. This is the first time we've seen a below average in a number of days now. Keeping an eye on sentiment, we're wondering if we're in this choppy period with the VIX as we go sideways in the earlier part of December before we historically see the VIX start to decline, wondering if it's going to play out the same way this time. The Ulcer Index turned up just a little bit, but is showing that there's not an awful lot of fear in the market. Keeping an eye on the line chart of the VIX, where we did turn down just a little bit on a down day. And when we look at the bar chart, it's also closing near the end or the lower part of the bar. Both of them are below their moving averages, showing there's not a lot of fear. Looking at the VIX of the VIX, even with the down day, we did decline with the bar chart and with the line chart, showing that volatility is starting to calm down. We're declining here with the VIX to VVIX ratio. That is longer term positive. We're also declining with the VIX to the 3-month average of the VIX. That's also longer term positive. The VIX to move ratio is almost falling off a cliff here as volatility is really dropping. We do have an updated chart here. This is the equity put call ratio, the daily chart, where it came up just a little bit because we closed lower. This is a little bit of a concern. We've been just chopping all around with our 5-day simple moving average. We came back to an extreme reading and then we started to drop. And the fact that this is declining is positive, but now we're getting down to this point where other times we often bottom, which will tend to mark some kind of a top in the market. We want to keep an eye on this. If it really starts to drop down below the red line, that could be a warning sign. Longer term, we're also coming back down to this lower line here. We're not below it yet, but we just want to keep an eye on that. Longer term, we are looking more positive with our 253 period moving average now starting to come down a little more decisively. Longer term, with the fear gauge here, we are looking more positive, where we ticked up just a little bit with our other fear gauge. We're still not really happy with what we're seeing here with the risk on to risk off ratio. It declined a little bit on Tuesday, which is not surprising with the down day. We want to see this really continue to go up. Longer term, it's still having a tendency to go down. It's showing some improvement, but we want to see this really advance. And then here's some other charts that I got from Isabel Net, just showing sentiment where we're starting to get extreme based on this particular measurement. And we're also getting extreme with this other sentiment indicator where we're going above this +1 standard deviation area right now. And a lot of time now this will mark a top, but we could go higher than this. This is just the latest reading. And then another thing that we keep an eye on for a sentiment reading is the insider transaction ratio. I usually, if I ever talk about this anymore, I usually only talk about it in the weekly video. But these are legal insider transactions. There's the illegal kind, which is where you work on an inside tip. Remember the movie Wall Street? Okay, that's why he went to jail at the end of the movie. Sorry to be a spoiler, but the movie came out in the 80s. There's legal insider transactions, and that's when CEOs and corporate officers and significant shareholders, they have to report what they're doing. There is a bit of a lag time with this. But when this gets up to a pretty high reading where it's at right now, that means a lot of insiders are buying. When it gets extreme, we use this like a contrarian indicator. Looking at our advanced decline line studies, we did come down slightly based on price and volume, but we're still well above the moving average. We're flattening out with our 5-period simple moving average. We're still seeing more new highs than new lows, but they're really starting to drop off. Our 10-period is rolling over just a little bit now, but it's still looking rather positive. We're no longer extreme positive with the 19-day exponential moving average of the advanced decline ratio. The blue line has come down. They both did decline, but they're still above zero. The accumulation distribution is still looking pretty healthy. We're advancing and above a moving average that is actually going higher. The chicken money flow starting to level out a little bit here. The red line hasn't turned up quite yet, but this is still looking positive. The cumulative NYSE advanced decline line, after getting above this trend line, it did close down below it. We're showing more improvement on a consistent basis with our regular NYSE advanced decline line. And also tick down just a little bit, but showing some improvement with our other NYSE advanced decline line study. And after breaking out based on price and volume with the common stock on the NYSE, we did see a bit of a pullback here. Looking at our advanced decline line studies, we turned down with the NYSE common stock as well as the S&P, the mid caps, and the small caps, but all of them continue to be above their moving averages. Our look at the daily chart where we pretty much have been chopping sideways now. This could be longer term positive for the market to work off this extreme positive condition by going sideways. But we do have some overhead resistance above current price. Now, at any time, this could turn to a full-blown decline, but it's just not happening yet. On the bottom, we finally did see a day where we dropped below the moving average. The Stochc RSI is extreme negative already, but it can stay here for a long time if we see more weakness. We're turning down a little bit with the force index, but we're still positive. It's green, even though it's declining below the midpoint. The short-term stochastic is no longer extreme positive. The intermediate-term stochastic is coming down, but still extreme. We're still flat with the longer-term stochastic. And we're no longer extreme with our standard deviations chart. We're getting more into the +2 standard deviation, where we had been camped out in the +3 for quite a while. Some intermediate-term charts. We turned down just a little bit with the balance of power, but we're still positive. The go-no-go system remains positive with the darker blue bars. And we're still seeing the midpoint of our highest high value continue to go up, even though we've been chopping more or less sideways. The TTM squeeze is no longer extreme, even though it's turning a little bit more negative with the darker blue bars. The ease of movement is still positive, but has been declining. And our Rune indicator turned down just a little bit. We could say that we were getting an extreme positive reading with this indicator, so the fact that this is working off could be positive. We're still advancing with the summation index based on price, but now we're starting to roll over a little bit based on volume. Also note, and I try to point this out periodically, the top part of this chart and the bottom part of this chart are two completely different indicators. They're calculated completely differently, but since they go with each other, I put them on the same chart. The summation index based on price and volume continue to advance. The Swenlin trading oscillator, another potential warning sign. We're starting to turn down based on price and volume. And the PMO is still extreme positive. It's rolling over a bit, but it hasn't crossed below its moving average. We're still advancing based on price and volume. And we're no longer extreme with the PMOs that are rising. We are still extreme with the buy signals, but it's starting to come down. We're still extreme with the PMOs that are above zero, but this is flattening out. We continue to be neutral with the Elder's Impulse system for the S&P 500. We continue to be positive with the parabolic SAR. Now, if we do see some kind of a downward movement, don't be surprised if we see a dot on the top. It likes to see price moving, and we haven't been moving all that much lately. So if we do see some kind of a significant downward move where we end more at the close, we might see a change in this chart. Looking at the slope oscillator, we're still extreme positive, but we're below the moving average and declining. This could be the way the indicator is calculated. The MACD is not quite negative yet, but is starting to cross below its moving average. So all of our oscillators, looking extreme with the slope, we're still extreme and we're declining with the slope. Where we're rolling over, but still extreme with the TSI, could be turning negative with the MACD, rolling over a little bit with the PMO. The PPO is just about ready to cross below its moving average. We're looking extreme with the TRIX and the KST, and the KST especially is rolling over, but hasn't turned negative yet. The Sean trend meter is no longer extreme positive. We're still above all of the plotted moving averages in our moving average tree. We're not quite extreme yet, but the bullish percent index continues to hang in there and is looking positive. The NYSE bullish percent index continues to advance. We're above 50. That's showing broader market improvement. And we're pretty much flat with the NASDAQ 100 bullish percent index after giving us an extreme positive reading. The Chaikin oscillator is still positive and advancing. The money flow continues to decline, but is still above 50. The ultimate oscillator also declining, but still above 50. The vortex, we're seeing the green line coming down after it did get extreme. This could end up being healthy if we turn back more positive. Now we're not showing an extreme reading with the green line. The RSI 14 and 9 are no longer extreme positive. On-balance volume is still above an advancing moving average. We turned down just a little bit with our 250 period moving average study for those stocks inside the S&P. The Copic curve is generating a sell signal. And here's a longer term look. After getting an extreme reading, we are now starting to come back down. We do look at our trend line. We're still above this previous high here. We haven't broke below that yet. So if we start to fall, will this continue to provide support? Looking at our different charts, we're kind of starting to chop sideways and showing some doji candles here with the Heiken Ashi. We're still positive with the Kegi, but we're still pointing down. The Renko chart is still positive, and the 3-line break continues to be positive. We haven't seen a change yet in the Zohorchak method from what we have been seeing lately. And looking at our other indexes, we did see some weakness with the equal weight, where the S&P actually held up a bit better. And we did see a real decline in the ratio between the S&P and the equal weight S&P, but it ticked back up as the mega caps held up better in Tuesday's session. We were down with the Dow, down a little bit more with the transports, and we declined with the utilities. And the transports are continuing to underperform the Dow. And this ratio is just chopping around right now between the Dow and the transports. And after really spiking up with the transports to S&P 500 ratio, we did see a decline. That's not necessarily good. We want to see this going up if we're going to turn more positive. We're still hanging in there with the Dow, even though it had a down day. The diamonds have switched from being positive back over to neutral. The NASDAQ has pretty much been chopping sideways. We were able to get back above this pivot level. So it closed down below that point after Monday. It came back above it on Tuesday, but we're not seeing any real breakout at this time. And with the NASDAQ 100, we're right back up to this pivot level, and it was up about 0.25%. But when we look at the QQQs, we remain neutral with blue bars. This is also potentially negative. The PPO for the NASDAQ 100 is now crossing below its moving average. That's turning more negative. The small caps, after really going up and getting above R1, well, they gave 1.5% of that back in Tuesday's session. And we came right up to this resistance level, and now we've been starting to come back down. Are we going to see what we've already been seeing, where we have a nice run up, give it back, and then we went sideways? Nice run up. Are we going to give it back again? We had been extreme positive with the RSI, with the Russell 2000 small caps. That's starting to wear off. We're still working off of a longer-term downtrend. And personally, this is what I use as the context. So as long as this is showing a negative downtrend, I would not consider going long in this. But some of you may be a little more aggressive and want to take advantage of that. I want to see the confirmation of the trend before I actually get into a position, and then I always want to go with the trend. But the trend in the shorter term still continues to be positive with the MACD. But I want to see the longer term and the shorter term trend confirm each other, but I tend to be more conservative with this. When we look at the small caps, they had been positive. Now they've switched back to neutral. The mid caps did get up to this R1 level and did pull back. We're still above the 200-day moving average, and we switched back to neutral for the Elder's Impulse system. The financial sector has had a really good run up, gave about 0.5% back, still working off of a recent golden cross. The micro caps did pull back almost 1%, but are still above 100. The FANG index was up after it had been seeing a few days of weakness now, but we're still having a difficult time getting back to this previous all-time high here. That's going to be a strong sign if we can get above that and then close above it. The dollar was down slightly, but we still are in a longer-term uptrend. Keeping an eye on bonds. We were down with the 10-year yield. We were up with the 10-year based on price. We're starting to climb back above the 200-day moving average. This is still kind of out of whack here. We're at positive 0.09 when we take the 1 month and subtract the 3 month. We should always get a negative result. An update of our possible positive scenarios. We saw a little bit of a tick up with the Qs to S&P. Discretionary, the S&P is still above its moving average. Saw a bit of a turn up when we look at large cap growth versus large cap value. When we look at our other growth to value ratios, turning up slightly with the large caps. We're coming down with the mid caps and the small caps back down to their moving averages. The 10-day average of the S&P 500 highs minus the lows, they still continue to be extreme positive. Now, this is a 10-day average, so it's going to take some time for these lower prices to start to get calculated into this whole mix. We're still above zero on the broad market look. When we look at the 5-period moving average of the highs minus the lows, the fact that we're above zero is showing some improvement. And our 50-period new highs, new lows study continues to advance above zero, because the red line, which is the moving average that we use on the previous chart, that is going back above zero as well. The 2-year treasury yield, has it spiked and is starting to come down? We're not really seeing any follow through with the S&P right now, but at some point this might give some support to the S&P. I have not received Tom Bowley's research yet for December. It's a free email, so it's not like I can complain about it. We are dealing with earnings season in our outlook. We're dealing with a lot of different geopolitical events that we're keeping an eye on. The technicals are positive, and I was actually able to change this a little bit. Right now, it looks like we're working off being overbought, but we want to be careful because working off overbought can easily switch over into overall weakness, and we're waiting to see how that's going to play out. We will get the MBA Mortgage Applications Index. We're also going to get the ADP employment change, productivity, and unit labor costs. This probably won't be really influential because it's the revised number. If it comes in drastically different, then it may have an impact. And we're going to get the trade balance, which usually is not that big of a deal, keeping an eye on all the different geopolitical events that could easily come into the picture. Here's the economic calendar. On Thursday, we're going to get weekly jobless claims as well as consumer credit, but the big one is going to be on Friday with the employment situation report. Looking seasonally for December 6th, we are neutral to positive with the Dow and S&P, where we're flat out positive with the NASDAQ. This goes from 2001 to 2021. It does not take election years into account. Looking at what potentially could be the January effect, where at some point in December, we tend to see the small caps outperforming the large caps. That's historically what has happened from 1979 up to 2022. Is that going to happen? It looked like it was starting to happen, but then we saw a down day in Tuesday's session. We will be on the fourth trading day of the month where we do see a little bit of positive seasonality with the green dashed line. And I've tried to mark out, and I don't know, I know all the different days of the month, but I've never had a zero. Okay. Today is the 0 day of December. Okay. And it's kind of weird. But anyway, we will be on the 6th, and we do see some positive seasonality when we look at the Carson research on this chart. And we're coming into Wednesday, which tends to be the weakest day of the week right now, at least in 2023. Of course, that could always change. And we do wonder if we're coming into this weaker part of December before we see more positive seasonality. Also, potentially sideways to slightly declining prices before we see more positive seasonality here. Also, maybe coming into this part where we chop around a little bit. Then when we compare it with the election versus non-election years and the Carson research, we're wondering, are we going to ever get beyond this first part of December where we do see more positive seasonality? And then we're wondering, are we coming into this part with the equity clock chart? Is this where we're going to see some more weakness going forward? But when we look at the Stock Traders Almanac for the NASDAQ, it just looks pretty hunky-dory. It also looks like we could see a bit of a pullback for the S&P 500. That's the green line. So what are our scenarios for Wednesday? We're not going with the negative one. There's really no proof of that. At this point, we are working off being overbought, but we haven't really developed into more full-blown weakness. So if anything, we still default to the positive side. We're not going with the sideways trend right now because we are in a trending environment according to our ADX charts. The warning signs, we're still keeping an eye on this risk on versus risk off ratio because overall it's been showing some weakness, some more weakness. There are days when it looks like it could be improving, but we're not seeing an awful lot of follow through. Our momentum oscillators, some are still rather extreme and some of them are starting to roll over. The Copic curve is now negative. The Russell small caps and mid caps continue to be in downtrends. The positive signs, our daily special K chart is still hanging in there. And when we look at our equity put call ratio, they're going down. We're wondering, is the 5 period starting to get extreme negative, which could mean extreme positive for stock prices, but it could still fall a lot more from where it's at right now. Longer term, we are turning back down, which is positive. Our oscillators are showing some weakness, but they still continue to be positive overall. The parabolic SAR chart and the vortex continue to be positive, but the vortex chart has been showing some weakness. The bullish percent index, it's been hanging in there and actually looking rather strong without being extreme yet. Small and mid-cap growth continues to top sideways, but it's in a longer-term uptrend. The financial sector, even though it pulled back in Tuesday's session, still generated a recent golden cross. And our longer-term new high, new low study continues to be positive and showing improvement. So our conclusion, we are positive, but we're working off being overbought. That's how we stand it with things right now. But we're looking for clues that more weakness may develop. And we're seeing that same thing in the short and intermediate term. Or even though you can't see it, just take my word for it. We're still positive in the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.